Joining us now on the line from New York, New York, Richard Katz. He is editor-in-chief of the Oriental Economist and author of Japanese Phoenix, The Long Road to Economic Revival. Richard, how are you doing in New York tonight? Thanks for joining us.
I'm doing great.
Good to hear. Let me, one of the reasons we wanted you on the program, of course, is that we're hearing a great deal of comparison between what the world is going through right now and what Japan went through in their so-called lost decade of the 1990s. This is your topic, so let me quote from a piece that you did in Foreign Affairs magazine, and we'll start there. In Japan, the primary problem was pervasive dysfunction in the economy, which caused a banking crisis. In the United States, pervasive dysfunction in the financial sector has caused a deep recession in the economy as a whole. This financial dysfunction is not the result of structural flaws, as in Japan, but of grave policy mistakes. It's now being compounded by widespread investor panic. Let's just unpack that a little bit if we can. The pervasive dysfunction that you referred to in the Japanese situation, what is that?
The companies themselves were actually very, very unproductive. We think of Toyota, Sony, very efficient companies, but 80% of the Japanese economy was internal, it faces a lack of competition, and too many of these companies made products that really weren't worth what it cost to make them. The total amount of bad debt by these companies added up to something like 20% of GDP. It was huge.
You also refer to structural flaws. What might that be a reference to?
Those losses and problems were not just the result of mistakes by management, but structural flaws built into the economy. Poor capital markets, poor labor markets, lack of competition, lack of antitrust, low import levels, any number of one-party democracy. So any number of things that were sort of institutional structures in Japan that tended to induce this unproductive behavior.
Now, as you look at the banking crisis in the United States compared to what we saw in Japan in the 1990s, similarities, differences, what do you see?
Big differences. Most, aside from the automobile sector, most U.S. non-financial companies are in very good financial shape, believe it or not. The problem is that we had a complete orgy of deregulation, which got financiers doing things that were just wrong. We had regulations for banks, for example. You can't give out a mortgage without someone having a down payment and proof they can pay it back. This was not applied to all of the so-called non-banking companies that were issuing mortgages, sometimes to people who weren't even alive, and then creating this huge unregulated market in derivatives. So it was really a financial system problem which could have been avoided with just some traditional sound prudential regulation. It didn't have to happen this way.
Okay, let's look at the, again, similarities and or differences in the mortgage situation. Subprime mortgage crisis in the United States, property bubble bursts. That happened in Japan as well?
Sure. In Japan, however, first of all, from the beginning, from, say, the peak of the bubble, 10 years after the price rises began, prices have gone up something like 600%. In the U.S., they went up something like 150%, so much smaller. Also, if you look at the U.S. housing situation, if you look at subprime adjustable rate mortgages, the foreclosure rate is something like now 22, 23%. But among loans that are guaranteed by Fannie Mae, one of the government agencies, most of which have to meet minimum requirements regarding down payment and proof that you can actually pay back the mortgage, the foreclosure rate is less than 0.5%, actually 0.6%. Huge difference. Regulation made the difference between good mortgages and bad mortgages.
So as you look at the so-called lost decade of Japan and you compare it to, admittedly, an economic crisis, the depths of which we still don't fully know because obviously it's not over yet, can you come to an opinion as to which one you think is more profound?
Well, the Japanese crisis was far more intractable because it was bigger, because the causes were built into the very structure of the economy, so you need institutional reform, and because the policymakers spent years and years and years denying there was even a problem. In the U.S., this is clearly going to be the most severe recession we've had since World War II. However, the problem is not as big. It does not penetrate the entire economy, but mostly the financial sector, and we have both a president and a chairman of the central bank who are very activist. If one thing doesn't work, they're going to try another. So we'll have a severe downturn. We're going through a severe downturn. We're going to come out of it much more quickly and much more strongly than the Japanese did.
Well, let me pick up on that, because one of the things we do hear a lot nowadays is that the people who are in positions to make decisions have learned, quote unquote, the lessons of the past, including Japan. One of the things that many observers have said is that the Japanese, when they had the opportunity to make good decisions, didn't. What did they do wrong that, as a result, made this crisis go on for a decade?
Well, first of all, they denied there was even a crisis. So, for example, the finance ministry actually ordered banks to cook their books to disguise bad loans on the theory that if strong banks showed they had bad loans, it would destroy confidence. So they hid the problem rather than admitting it. Secondly, the Bank of Japan kept interest rates high very long. It took Ben Bernanke about 16 months to bring interest rates to zero or close to zero overnight rates. It took the Japanese about 8 or 9 years. President Bush a little bit and then President Obama very, very strongly have applied an awful lot of fiscal stimulus to fight the collapse of the economy. The Japanese did so in a much smaller way, in a very stop-and-go fashion, and they even raised taxes in the middle of a slump, which is the opposite of what any textbook would tell you should do.
Well, when you're talking about the banks, the Americans, of course, have put hundreds and hundreds of billions of dollars into shoring up their banks. Given the Japanese experience, is that the right thing to do?
What you have to do is, yes, you have to put money into the banks, but you have to do so with making sure, first of all, you get the bad assets off the books of the banks. They failed to do that for very long in Japan, whereas the banks in the U.S. are getting rid of a lot of their assets. The problem is not the banks per se, it's what they call the shadow banking system of all these derivatives and what are called mark-to-market assets, where you can have, let's say, commercial mortgages where the default rate is very low, but the derivatives, the securities based upon those mortgages may have lost 30% of their value because of just panic in the market. So they have to change the regulations about how mark-to-market is dealt with. And you need to separate the good operations of these banks from either the genuine problem loans of real borrowers or this whole shadow system of unregulated derivatives. It's more complicated, the financial situation. It's not bigger, but it's more complicated as to what to do.
I think I read in your piece that the Japanese government spent 2 trillion yen to effectively nationalize a bank, and then after that allowed some of the weaker banks to fail. Do you think, now obviously the States is trying very hard not to nationalize banks. Do you think they have to nationalize one or two big banks and let many others fail?
I'm not sure, because it's a more complicated situation, and some of the biggest banks like Citi or Chase is such a huge part, JP Morgan Chase, such a huge part of the U.S. economy. But clearly you need to have government capital injections into the bank with government control, government rules, and find a mechanism that separates the good assets of the banks from the bad assets. We've had some experience with the Resolution Trust Corporation. We can look at the Swedish experience of nationalization. We look at the Japanese experience. So the exact technicalities of it, experts on this are still debating it, but the basic principles, which is separate the good assets from the bad assets, use capital injections to shore up the banks while you do that so you don't have a collapse, a change in the mark-to-market accounting rules so you don't have assets being written down even when the underlying loans the borrowers are paying on time.
How long did it take the Japanese officials to realize that their banks would have to undergo rigorous audits and that the truth, of how strong these banks were would have to come out?
About 10 years.
10 years. So America is already ahead of the game.
It began about 6 years with some opposition members of the Diet, but really took about 10 years before they fully realized it.
So does it look to you as if the U.S. has learned that lesson and are moving more quickly on it?
Absolutely. The lesson that the U.S. has learned from Japan is it's much, much better to do too much than too little. It's much better to move too soon than too late. It's much better to admit the problem, even at the risk of some confidence issues, than to deny the problem and the idea we're going to restore confidence, because reality does intervene. So you got to tell the truth. So those lessons have been learned very clearly by the Obama administration.
And again, on this sort of stimulus package, the $787 billion package that Congress recently passed, again, based on the Japanese experience, would you say that's the right way to go?
It's the right way to go, but it's, one, not big enough. They're going to have to do more. And secondly, because of the bargaining that had to take place with Congress, particularly in order to get a few Republican votes, some of the things that would have been most powerful and most early in their impact were downsized. For example, expanding unemployment compensation. For example, giving an awful lot of aid to the states and the cities so they don't have to cut budgets, which causes people to lose jobs, causes loss of income. If they had done those things, the money would be pouring out into the economy, saving jobs and increasing spending power more and earlier. So the bill was unfortunately watered down. They're going to have to come back and I think do more. But certainly it's far better than the Japanese did.
Let me pull something a bit out of left field here. And I had one economist friend of mine suggest to me that one of the problems Japan had that was a significant contributor to the lost decade was the fact that Japan is thought to be a somewhat xenophobic country when it comes to immigration. The population is declining. They do not have high immigration rates, and as a result, that contributed to the difficulty in creating economic activity and pulling the country out of it. Would you say that that was a factor?
I think that's really a tertiary factor. The population is actually not yet declining. The population is stable, about to go into decline. The working age population has declined. That's a problem. The energy you get from immigrants, for example, Silicon Valley, I believe something like 40% of the engineers in Silicon Valley were actually born in India or East Asia. So that kind of energy and fresh blood, they don't have there. But that was not really the fundamental cause of the problem. That's a long-term issue they have to deal with. But that's not why it took them 10 years to get out of the crisis. It's not why they got into the crisis in the first place.
I understand that, but if the population is moving, say, from 120 million towards 100 million within 30 years or 40 years or so, and they seem to be, as you just suggested, exporting some of their smartest people, I mean, that can't augur well for the future, can it?
No, and that's absolutely a long-term problem they're going to have to address. But what I'm arguing is that you don't have to wait for that solution to cure the problems that are preventing growth today.
Okay, let me ask one last thing in our last minute here, and that is, you've learned the lessons. You clearly have written about the lessons of Japan's so-called lost decade. Does it appear to you that America, A, has, and if it has, is it going to take 10 years for America to come out of this?
Well, you know, Tim Geithner, the Treasury Secretary, actually spent some time in Japan working for the embassy there, so he knows the Japanese situation firsthand. Unfortunately, he's not yet presented a situation that is very clear-cut and transparent, that people even understand what it is, let alone if it's the right solution. So he's got to work on that. The lesson as far as you've got to move big, move quick, etc., certainly they've learned. Ben Bernanke, the chairman of the Federal Reserve, understands the Japanese situation very well. He's written about it, he's given speeches on it. So to the extent that there are lessons to be learned, I think they've learned them. The problem is a different situation. Something that cures cancer won't cure a heart attack. It's just a different situation. But you do know in both cases you've got to move quickly. It will not take us 10 years. It's going to take us longer than we previously thought. We may not see the bottom to the end of this year or early next year, but 10 years, no.
That might be the first optimistic thing I've heard about the economy on this program or any other in a long time, so we thank you for that.
Well, if to say it won't take 10 years is optimism, that shows the degree of fear that's out there.
That constitutes good news these days. Anyway,
Yes.
Richard, it's good of you to join us on the line from New York. Thanks so much.
Well, thank you for having me. I enjoyed it.